On the Wintrust Business Lunch, John Williams here with Craig Bolanos, the co-founder and wealth advisor at VestGen Wealth Partners. GetRetiredStayRetired.com is his website. Welcome back to the show, Craig.
Hey, John, great to be with you. Lots of news to unpack, and wow, the home market appears to be moving again once we got interest rates to a 3-year low.
Yeah, although we're talking about the August sales, right? And the interest rates have dropped most recently. Are we talking about the same thing here?
Well, we're talking about the same thing. I think what's happening is, yes, we just printed 3-year lows on mortgages. I mean, John, I remember how bad it got to me. We're talking 8%, then 7%. We're back to 6.1, et cetera. That is a much more discernible number to maybe consider all those growing families out there to trade out the bunk beds in favor of bedrooms. If anybody thinks we're getting back to 3% mortgages, not happening. I don't want it, but 6 is a decent number right now today.
That's interesting. Maybe we don't want 3% because then those people will never leave those houses.
You know, I don't want 3% again because 3% means we're probably going back to zero-rate interest policy, and the only reason to ever have zero-rate interest policy means we're going through something so bad, so ugly, and so economic like the great financial crisis. And to be sincere, John, I don't want to live through that once again.
Or the pandemic, right?
Or the pandemic. That's correct. Shouldn't forget about that.
Well, what do you think then I guess it's too soon to know, but if these are the August numbers that are so good, new home sales shot up 20.5% to a seasonally adjusted annualized rate of 800,000 units last month. Do you think September is going to be as strong?
I think September is going to be a decent print. I mean, granted, the biggest problem, of course, we have in the housing market is we have to think about the calendar. We have to think about school, right? I mean, housing generally tends to cool off once we get to the other side of Labor Day because schools and districting needs to be in place. But I think the trend and the importance of lower mortgage rates speaks for itself. And when we can get housing moving in this country again, that lends to more consumerism, more spending, because you have to think about all that goes in to when people move. That's a big amount of consumerism in America.
And I was thinking year over year, but I don't remember what September rates were in 2024. But I'll take your point that the trend is good. And is that because of the Fed? Is that the lever here?
I think it's a confluence of everything. I mean, we have officially re-entered a cutting cycle. I mean, we just got that first rate cut here earlier this month, first rate cut in more than 9 months, and all indications, even though there's some dissentment, even though you hear news, I mean, when I look at Fed Fund futures, there's still a 94% chance of a reduction on October 29th. There's another 75% chance still of a reduction on the 10th of December. So yes, John, it's the anticipatory move of 2 more cuts from the Federal Reserve that influence the 10-year Treasury, which influences the mortgage market, and it's nice to see.
The Fed's more interested in jobs than inflation right now. Do you want to see 2 more 25 basis point cuts this year?
You know, you have been so gracious and allowed me to visit with your viewing and listening audience all throughout the year. And the table stakes for VestGen Wealth Partners has been that we needed to have at least 2 rate cuts to support the high multiple on the S&P 500. So I'll settle for 2. But if you ask me what I want, no, I want 3 because I do think the labor market is going to continue to give up progress. I think we are going to continue to see the headline unemployment of non-farm payrolls creep higher, and for that reason, I want the Fed to get in front of this.
Of course, you'll probably get some rate cuts next year too, right?
I'm looking for, again, 2 rate cuts this year, and I'm looking for a follow-on act of at least 1, preferably 2, into 2026. And if we do that, I think we actualize to a decent spot. I know savers are going to be incredibly disappointed. Everybody enjoyed their 5% money markets and high-yield savings, which turned into 4, which are slowly heading back down to 3. And while it's bad for savers, I think it's definitely good for investors because there's that old saying, John, don't fight the Fed, don't fight the tape, and even if I'm worried about some of the things happening in the world, I can't look past the fact that you generally want to own stocks when the Fed is cutting rates.
So too bad for people that want the guaranteed but lower, say, savings rate, but also too bad for people who are going to be out of a job or have less of a job than they want. Is that sort of the price we pay for this, Craig? In a minute. I also wanted to talk to you about the stock market itself and some of the sectors on it. We're talking to Craig Bolanos, the co-founder and wealth advisor at VestGen Wealth Partners. Bob Kessler, Bolanos on the Wintrust Business Lunch from VestGen Wealth Partners is on the line. We're talking a little bit about the markets and how things are going out there. Let's see, Craig, let's pick it up where we left off. And I'm trying to remember where we left off.
Well, I think we left off talking a little bit about jobs and how that relates to investing in today's climate.
Yeah, right. I said, is the price we're going to have to pay for lower interest rates and maybe better performance by equities, is it going to be people with fewer jobs or less of a job than they'd like to have?
You know, unfortunately, we're already seeing it. I mean, I pinch myself because I must have been dreaming in 2023 when the unemployment rate was such a soft 3.4%. Now we've seen that unemployment rate climb to 4.3%. I won't be surprised at all if we possibly print as high as a 4.5% unemployment rate by year-end 2025, John. And why is that? Because right now it appears we're in a no hire, slow fire mentality. So I think those headline unemployment numbers are going to continue to creep up, which means those who lose their job are spending even more time looking before the acquisition into a new one. And again, that's one of the reasons I want the Fed cutting rates here.
Is it that way because employers are just reticent to hire or expand because they still are worried about tariffs?
It's a confluence of several things. The list is long and probably distinguished. You could put tariffs on the list. You could put high inflation on the list. You could put the forecast for still growth, but slower growth. And don't forget the need to continue to invest in artificial intelligence. Capital expenditure for AI infrastructure is big, and the money's got to come from somewhere. And unfortunately, that means some employers trimming jobs at the margins to free up the cash for the investment.
847 says, hey, John Williams, I just refied for 5.8%. So happy, with 4 exclamation points. Well, how about that, huh?
I think that's a huge win. Think about how much money that puts in someone's pocketbook if they acquisition that old mortgage just a couple of years ago. If you can save 1 to 2+%, boy, the amount of increased cash flow going to an American consumer is ginormous. I'm excited about that text or tweet that just came in.
Yeah, I wonder if that's a 15-year note. It's whoever it is, they've got a good credit score. What part of the stock market do you like right now?
I think people need to continue to lean into AI enthusiasm because it's real. It's very real. But at the same time, we all need to have good governance when it comes to valuation. I mean, you see some of the tech stocks getting a hit today, but hit is really just taking one step back after the likes of the NVIDIAs, the Oracles, you name it, have taken what seems to be 11 steps forward recently. But I still think the story for everybody is this: just to make sure that they're leaning into where the puck is going to be. I think healthcare is a great opportunity. I think industrial and material stocks are a great opportunity. And I think the artificial intelligence story is not just about the Magnificent Seven. The artificial intelligence story is about how non-technology companies will be adopting AI with success in the future in order to enhance the human productivity, which does drive earnings per share. So stay an investor, but don't get too far over your skis and rebalance those portfolios to stay in line with your risk budget.
Right, but you're saying rotate to other equities. You're not saying go to bonds or something like that.
Well, I think bonds definitely have their place, and what I remind anybody is tax-free income right now, For those who have sat out and not paid attention to the municipal marketplace, I think there's a lot of investors of varying marginal tax brackets who might be wise to shift from some taxable bonds to intermediate to long-term municipal bonds, which is a tremendous opportunity. But am I making a call for people to de-risk their portfolios right now, John? No, but I'm asking investors of all shapes and sizes if their retirement plan requires them to be, say, 60-40 stock to bonds, or maybe their retirement plan is 70-30 stock to bonds. Don't exceed that equity ratio, rebalance to target. Don't be an overweight position today.
What does long-term muni bonds pay?
You can get tax equivalent yields, John, of almost 7% in today's marketplace in the right areas of the municipal bond market. That's why I consider certain areas of the muni bond market to be on sale, because tax equivalent yields of 7, that's a tremendous number.
And what's the risk on that? I mean, that's not guaranteed, is it?
Well, if you hold a bond with a good credit quality to maturity, that's the type of yield to maturity that you can get. And I think for all investors in bonds, most of us buy bonds because we want to stay wealthy. For a lot of us, bonds are the ballast in our portfolio. And when you can achieve, again, that's a tax equivalent yield, John. Again, when you can achieve high tax equivalent yields with good credits, I think it's a great spot for people to be and lean into.
What do you mean? Go ahead.
And, of course, if we're going to continue to drive rates lower, it's kind of like this. Get them while they're hot today. I mean, I tell people all the time that are in high-yield savings who don't have an intention of investing that cash in bonds. They don't have an intention of investing that money in stocks. Maybe some of those high-yield savings accounts belong in CDs so you can lock in today's rate before you have reinvestment rate risk coming by the end of the year.
Craig's website is getretiredstayretired.com. He is the co-founder and wealth advisor at VestGen Wealth Partners. Craig Bolanos, nice to talk to you.
John, thanks for having me on.
News from the North